Hello and welcome everyone to the week ahead commodity report, where we of course will be reviewing the markets for the week ahead. And the last week has been another perfect example of why you need to be banking profits regularly in the precious metals market. As we mentioned to you previously, we banked 10,000 points across 10 positions on gold. For each one lot that you would trade, that's going to be $100,000 of profit. For each 10 lots you would trade, that's $1 million of profit. Now, over the last week and a half, we've seen over $140 drop in gold prices, breaking down from 1,959 US dollars per ounce all the way down to 1,817 US dollars, and then closing on Friday at $1,828 per ounce. And with that, of course, we did see that consolidation later on in the week and some pressure as well after we got the news regarding the economic plan, which went from promising a $2,000 stimulus check down to $1,400. So overall, Joe Biden's proposal of $1.2 trillion in stimulus, it is going to have a huge impact on the markets. But first, he needs to take office and then get that stimulus plan passed through the House and the Senate. The big question now is how quickly Joe Biden will be able to pass the $1.9 trillion stimulus plan, which leads on to the major theme expected to dominate sentiment this year, which is inflation. Biden and the Democrats will not stop at $1.9 trillion, which will be a strain on the balance sheets. With the Democrats controlling three branches of government, this will be a blue wave and expected to create massive levels of fiscal and monetary stimulus, which will continue to provide that extremely bullish backdrop for commodity prices to skyrocket and reach those new all-time highs. Now, the last time the Democrats controlled the House, the Senate, and the White House, gold was trading below $900 per ounce in November of 2008. 3 years later, gold prices, they peaked at 1,921 US dollars per ounce. So if history is anything to go by, then we could be in for a very exciting and lucrative time ahead for the precious metals. There's no doubt we're going to see unprecedented levels of money printing ahead. Now, as we move into next week, the major events that you want to have on the radar are going to be Joe Biden's inauguration on Wednesday, which will be accompanied potentially by civil unrest, and we also have Trump's impeachment trial, which are going to be major political events going into next week. Washington will very much be in the focus of the world's attention going into next week as Joe Biden is inaugurated as the 46th US president on Wednesday. But there's the potential for a repeat of the civil unrest we witnessed on Capitol Hill previously, which again can move the market significantly. Other market-moving events would include Janet Yellen's confirmation hearing as the US Treasury Secretary on Tuesday. Traders will be monitoring her comments for clues on stimulus. Also on the radar going to next week will be central bank policy decisions from the European Central Bank, the Bank of Canada, and also the Bank of Japan. So with that, let's move over to the charts and we'll talk you through exactly what we're looking at here as we go into a new week. So firstly, if we have a look at gold here, here is case in point as to why you don't want to just be buying and holding right now and why you need to be nimble, banking profits off the table regularly. As many of you know, we built 10 positions over this period of December. So we continue to stack into trades here that we let run up into the first week of January. And then in the first week, we banked 10,000 points across 10 trades on gold. So when we had that breakout towards the 2-month highs, when we had the gap on the open, the push higher, we were taking profit off the table. It's very common in the first week of January, as many traders are coming back from the holidays, they miss the breakouts that we see over December. They are FOMOing in on these breakout moves that we've seen where gold prices broke out to 2-month highs. It's basically been a liquidity trap at that zone, and we've seen a takedown from that level, a big magnitude of a takedown. Therefore, if you've been able to take profits from the breakouts here at the beginning of January and then wait patiently for the markets to correct again here, as you've seen with a significant sell-off that we've had over the last week and a half here, this is a great opportunity then to reload again. Wait for these big corrective price action, wait for the market to become oversold, wait for the sentiment to get very negative again for gold, very much like we had back at the end of November, beginning of December, and then you can start testing out zones for reload opportunities. You can see in the last week, effectively gold has just really been range bound. So all we've really seen here is a ricocheting of resistance, which has been residing at approximately 1,863 US dollars per ounce, and we've come back down towards 1,817, and then we've had this chop zone in between approximately 1,800 and about 25 to $30 per ounce, up towards that 1,850 to 1,860. So if you have a look at this, for example, on lower time frames, you'll see exactly what I mean. So it's just been up and down, and just really chopping and consolidating just really throughout the last week or so. So you've been within quite a tight range here on gold, and that does provide quick opportunities to come in and out the market quite regularly. But again, it's not a buy and hold market where you just want to be buying at the lows in December, for example, and just carry that all the way through. You need to be banking profits regularly. And of course, what's happened to many traders is effectively they've bought right at the high here. They've had their technical confirmations of the breakout from the weekly chart that we discussed with you previously. So many traders were coming back after the Christmas holidays. They see the bull flag on the weekly chart, the breakout that we had here, the false breakout. They get triggered into their trades and then liquidated on the large sell-offs that we've seen. Predominantly what we've seen at the beginning of the year as well is many narratives for gold got ultra bullish. A lot of traders are FOMOing in. They get caught out on the move, and now they're stuck, either liquidated now or they're stuck in much higher positions where they would have been much better off just regularly banking those trades, because then on the big pullbacks that we've seen, they've got capital available to reload at better prices and just to take advantage of the current price action that we're seeing at the moment. We've also had very similar with silver and platinum over the last few days here. So moving over to silver. So silver, we've continued to build those positions between $22 to $24 per ounce. We've taken some profits on these breakouts to the upside. All of those trades, of course, they're still in profit. We did see last week into the close another rollover, pullback in price action as, of course, the stimulus plan being proposed by Joe Biden falls short of expectations. So we have had some pressure to the downside yet. And of course, this hasn't all been pushed through yet. Won't happen until he comes into office from next week onwards, from Wednesday onwards. That's when you could start to see more bullish price action for the metals. So at the moment, we've of course had that sell-off on Friday, consolidated throughout most of last week. Same really for silver here. It's been finding resistance at approximately just below $26 per ounce and support around that 24.50 zone. If you drop it down into lower time frames, you'll see where it's just been ricocheting between support and resistance over the last week here. So you're just bouncing within these tight ranges at the moment. So again, you want to take profits off the table regularly when you're trading gold and silver. They're moving over to platinum. So platinum has been leading. Platinum almost broke out to 4-year highs last week. We had a strong push higher in the last week, up 2.4% over Monday through to Friday, and then we've had this corrected price action on Friday here. In fact, up until Friday, platinum prices were up 7% on the week, and if you look at that on higher time frames, you can still see where it's had a strong push and a positive weekly close. On the monthly as well, we've seen a fairly significant push higher so far. Of course, we're only halfway through the month at the moment. So as we go into next week, we've seen those pullbacks on the metals. The dollar, of course, picked up momentum to the upside on Friday as well. With that, we saw weakness into the close on stock markets, on energies, and across most of the commodity markets. But we have a lot of news events as we go into next week. And again, it just really drills home the point that you need to be banking profits regularly. So don't expect the market just to go up in a straight line. When you've got a windfall amount of profit, make sure you're locking in profits and you're protecting trades, and this will give you the ability to keep reloading in the markets and take advantage just really of this consolidation and choppy price action that we've got at the moment on the metals. That is the best way to take advantage of the current market volatility, and that will really avoid you getting trapped into trades like many of the technical traders out there who are taught incorrectly outdated technical methods, where they keep getting essentially chopped up in the market. They buy at the highs and then they panic sell out of the lows here, and they're just constantly losing money in the market. And of course, you want to avoid that. You want to be trading the same way that the professionals are, the hedge funds, the banks, the institutions. Be aware of levels which are targeted by the market makers in the market. That will help you massively to get an edge. Of course, alongside that, you want to be aware of capital flows, the daily cycles, the weekly cycles, the monthly cycles, macroeconomics. Alongside that, utilizing in-house data or intelligence in the market. Market sentiment is also very important, and marry that up to the intermarket correlations and what, of course, the big banks, institutions, hedge funds, and money managers managers are doing on a regular basis, and that will help you massively to get an edge. So with that, if you would like to join our community of successful traders, learn the research-driven approach to the market so you're not going to continually get trapped in these bull traps and bear traps, and definitely want to avoid all these outdated old technical strategies which are getting taught at the moment in the market. So if you would like to learn the research-driven approach to the market, join our community of successful traders, there is an opportunity for you to do so. Just make sure you click in the link below today's report in order to make an application to join our professional mentorship program. As a member, you get access to our exclusive live trading room webinars. You have access to our real-time trade ideas, institutional research and market intelligence, access to our private members academy website, and support and one-to-one mentoring. For more information, just go to www.jointhelivetradingroom.com. The link is also below this report in the description, so just click on the link, make an application, and we will of course get in touch with you ASAP. And do make sure you subscribe to our YouTube channel, that way you're always kept updated with all of the latest commodity reports.